Welcome back to Question Time. The markets are constantly changing, and so are the questions we get for Joe Calhoun. Steve, what have you got for Joe today?
Yeah, Joe. Well, we've got personal income growth that appears to be weakening. Supposedly transitory inflation is appearing a bit persistent here. How big of a worry is stagflation getting to be for the Fed?
Well, I think it makes their job a little more difficult, but let's talk about that word stagflation. You know, a slight downtick in growth and a maybe a little bit sticky inflation. Yeah, that ain't stagflation. Sorry. All of us who lived through the 70s know what stagflation is, which is unemployment a hell of a lot higher than under 4%, near a 50-year low. That's not stag. Okay, it's just not. And the inflation part, neither in the threes, is not what we saw back then either. So I would say, look, and I think we have to be careful about the language we use. Stagflation just, evokes these memories of, or these institutional memories of just really, really bad times. Well, that's not where we are. But I do think that that it's interesting how we're seeing inflation be sticky. And the thing that stuck out to me last week was the Case-Shiller index. Case-Shiller home prices, the national index, is up 7% year over year, and was up again for the 9th straight month. Now, Case-Shiller lags for a couple of months. I think that was March numbers. It takes a while because they get this from the data that gets when you buy a house, you have all these documents that get filed with the county and the city and so forth. Well, it takes time for that stuff to get recorded, and these prices in Case-Shiller come from those recordings, so they're always lagged by a couple of months. So when you look at this and you're looking like March. Anyway, the point is that house prices are continuing to rise, and at the same time, like you said, I did point out last week that we were seeing this downshift in income. Real disposable income growth. It has shifted down to a growth rate under 2%, around 1.3 actually, if you're looking at the last 3 months. The year-over-year change, average monthly year-over-year change is about 1.3 over the last 3 months. It was higher than that for the previous 6 months. And if you go back a year, it was quite a bit higher. So it is starting to be a trend. And I think that that's not a good sign. Having said that, income and consumption is not really what drives the economy. That's more of an effect. So, for instance, with consumption, you usually don't see consumption fall until you're in recession. So it's not a leading indicator. What concerns us more would be on the investment side of the economy, and that's where we'll see what happens here. Look, we haven't seen a lot of impact from the Fed's rate hikes. We've seen it in the housing market, no doubt. But it hasn't affected prices. It hasn't affected prices because there's limited inventory. And there's limited inventory because rates went up, which is kind of weird when you think about it. You think about all these people out there with a mortgage in the 2s or 3s, they're not going to move. They're just not. That's why you're stuck with 3 to 4 months worth of supply at the current really reduced sales pace in inventory in existing homes. So it may be interesting. If you get rates to fall, you might actually see more inventory, and maybe it would moderate some of these price hikes on the housing side. Now, look, the rest of the inflation reports that we've seen, I don't think they're really all that bad. I think they're actually pretty good. There's still disinflation going on. The inflation rate is still falling. Somebody in the comments not long ago made a point of that I didn't know what I was talking about because I said inflation was falling. All right, so I'll give them that. Technically, I suppose that's true. Inflation, the CPI, is an index. The index is not falling. The rate of change is falling, which is really what matters for the Fed and for everybody else. But anyway, I think that it could be interesting. But what I'm concerned about here is that we're starting to see growth slow. That's really what my concern is, more than the inflation side. I think the inflation will take care of itself. I'm not too concerned about it. But I am concerned about growth, and that's really where we should be focused.
What questions do you have for Joe? Put them in the comments section down below.